For thousands of years, humanity has measured not only its needs, but also its trust through money. From stones to crypto codes, this journey is the story of how humans create and preserve value. Throughout human history, the most fundamental element at the core of economic relations has been money. Money is not merely a medium of exchange, it is also a powerful instrument that has shaped the social, political, and cultural structures of societies. Initially, people relied on the barter system to meet their needs directly. However, this system required a double coincidence of wants, meaning both parties had to need what the other offered, which limited economic activity. As a result, humanity began to search for a universally accepted, portable, durable, and divisible medium of exchange, marking the birth of money. In the early stages, money derived its value from the material it was made of, known as commodity money. Gold, silver, copper, salt, and even seashells were used as means of exchange among communities. These items carried both economic and symbolic value. However, as trade expanded, transporting and storing such items became increasingly difficult. To solve this, precious metals began to be minted in standardized forms. Around the 7th century BCE, the Kingdom of Lydia introduced the first metal coins, a revolutionary milestone in world economic history. Coins combined the roles of a store of value and a medium of exchange, accelerating trade and enabling states to establish stable economic systems. Over time, governments promoted the use of metal coins, but even as trade volumes grew, even coins became cumbersome to transport. Consequently, documents representing deposits of precious metals, representative money, emerged. These documents guaranteed a certain amount of gold or silver and could be transferred securely. This innovation paved the way for paper money. During the Tang and Song dynasties in China, paper currency became widespread, and similar systems later appeared in Europe. Although paper money lacked intrinsic value, it functioned effectively because it was backed by the authority and credibility of the issuing state. Thus, the concept of fiat money was born. Its value depended not on the metal it contained, but on the collective trust of society in its worth. The Industrial Revolution brought massive production growth, capital accumulation, and global trade expansion, leading to the creation of new financial instruments. Checks, bills of exchange, and bank transfers facilitated the safe transfer of large sums of money. The banking system evolved into the backbone of modern economies. During this era, money became increasingly abstract, no longer just a physical object, but a record of value in electronic systems. By the late 20th century, with the rise of computer technologies, digital money emerged. The spread of the internet accelerated electronic payment systems. Credit cards, online banking, and electronic currencies propelled the digitalization of money. The most transformative stage in this evolution came with the rise of cryptocurrencies. Following the 2008 global financial crisis, growing distrust in traditional financial systems spurred interest in a decentralized alternative. In this context, Bitcoin, launched in 2009, introduced a transparent, borderless, and decentralized digital currency powered by blockchain technology. Unlike conventional money, cryptocurrencies are not controlled by any government, central bank, or intermediary. Transactions are verified through cryptography and distributed ledger systems, allowing users full control over their assets. Cryptocurrencies introduced significant innovations and opportunities in global finance. Lower transaction costs, faster cross-border transfers, and 24/7 accessibility have revolutionized international trade. Additionally, the transparency of blockchain technology reduces fraud risks by recording transactions immutably. However, cryptocurrencies also face major challenges: extreme price volatility, lack of regulatory clarity, tax uncertainties, and the potential for money laundering. Moreover, if users lose their private keys or wallets are hacked, their assets are permanently unrecoverable, a major security concern. In light of these developments, the evolutionary journey of money has mirrored humanity's changing economic needs. From barter to commodity money, to metallic and paper currency, and now to digital and crypto forms, money has continually adapted to the technological, social, and economic realities of each era. Today, money has transcended its physical form, becoming lines of code, data streams, and trust algorithms. Yet, its core functions remain unchanged. It still serves as a medium of exchange, a unit of account, and a store of value, only its form has transformed. One of today's most debated questions is whether cryptocurrencies will eventually replace traditional financial systems. Some view them as the natural next step in monetary evolution, while others see them as speculative bubbles. Meanwhile, central banks worldwide are developing their own central bank digital currencies, state-backed digital currencies that combine the reliability of government money with the efficiency and speed of digital systems. This trend suggests that the future of money will be fully digital. In conclusion, money stands as one of humanity's greatest inventions, and as long as it exists, it will continue to evolve. The history of money is, in essence, the history of human trust, value creation, and economic cooperation. Cryptocurrencies represent a new phase in this story. Although they remain controversial, they are undeniably shaping the future direction of money's evolution. The transition from physical to digital and from centralized to decentralized systems marks a revolutionary transformation in the way humans engage in economic exchange.